Hi, students. This is a discussion on General Mills, and next case we'll take up is Nike. I don't think it will be a long video because already the skeleton is with you. But to help you connect to the whole discussion, I'll just indicate some uh, macro figures like total operating assets. And if any item I feel like that's bit peculiar asset or liability, I just need to explain a little more. I'll spend time on that and then move to the next case. Please understand that this case has given us this figure, operating cash of 50-50. Very unlikely that the figure will be same across 2 years, isn't it? So out of the total cash holding, it is given in the case, treat 50 as operating cash, and the balance cash you have to treat as financial asset that you can see under financial assets. If you go here, you can see the cash equivalent figure 611. Here it is a minus figure because you are trying to deduct it from the financial obligations to calculate NFO. This balance sheet has a situation of NFO. Financial assets are less than financial obligations, right? So I don't think I should explain to you now. Total cash in the balance sheet therefore should be 661. 611 is here and 50 is here. That's how they have told us to proceed with. Okay. And you can just go through the entire list of these assets. I don't think I'm again going to explain that. Everything here is operating asset. One item which is still to be explained in the class is DTA, deferred tax asset. And same thing under liability, you'll have you'll find one item called deferred tax liability. We'll try to cover that on the, I think on 3rd I'm going to meet you, and again on 5th I'm going to meet you. Next session we should open up for this item. This is the most vexed item in the financial statement, as I have mentioned many times. So that's the total operating asset you have. So this I can just put it here as total operating assets. Then as usual we have operating liabilities, that is accounts payable or trade payable, the same thing. Here you can find this company has some sizable DTL number. And then you have other liabilities. Because we don't have the details in this case, we're safely treating that as a part of operating liability. Then you have a situation of NOA, that is operating asset minus operating liability, 12847, 12297. Now that we have calculated NOA, let us straight away jump to average NOA figure and then finish this discussion at a particular stage. You can see that average NOA figure is 12,572. That is, if you just track the formula C19 and E19 divided by 2 summation, these two figures have been pulled there. So all the figures are in the file. I don't think that will create any kind of problem. You just go to the cell and trace the figures in the formula bar. Automatically you'll come to know what figures we have taken, isn't it? So that gives us the average NOA. Then going into the rest of the figures in the balance sheet, you have NFO situation, that is financial liability. You have three financial liabilities here: current portion of debt and long-term debt. This 442 is a part of 4349, and you know in accounting the current portion should go to current liability section and the long-term should go to non-current liability. This item, notes payable, please understand that notes is a debt instrument. Okay, so it's a debt instrument, so it will come under financial obligation. So we have NFO figure. Then we have 36389 and 5839. So as usual, we need the average NFO figure, that is 6114. I'm just clicking the formula bar. You can see that these two figures have been pulled for calculating the average. Done. So I think we're done with these two calculations. I'll just highlight it in some kind of, color. Then we move to the equity figure. Since this is a balance sheet where you have NFO, the balance sheet equation will be obviously, I'll just use this space to type out, okay? Maybe this space, okay? Final balance sheet equation will be NOA is equal to equity plus NFO. Therefore, if you want to connect equity, it should be logically NOA minus NFO. And if that tallies with your balance sheet equity figure, General Mills case doesn't have any component under equity, like say, for example, stock options, which we are already aware about, which you are going to reclassify as operating liability. Means equity figure is not going to change. Similarly, under liability, if you don't have any item like dividend payable, which you would like to reclassify as a component of equity, then obviously the equity figure will change. But General Mills doesn't have any such item in the balance sheet. So we have a very simple case, that is NOA minus NFO is equal to total equity. You can see that this figure is nothing but the NOA figure 12,847 minus 6,389. That takes care of our equity. Since we are calculating ROC that is based upon the total equity, bifurcation of equity into the two components as you would find in consolidated balance sheet, that is one portion is attributable to non-controlling interest stakeholders, and the remainder part is equity attributable to shareholders of the parent. I think almost each one of you should be clear about this bifurcation. In case somebody is just unable to connect to this point, for the sake of that, let me clarify. This non-controlling interest is the portion of equity of the subsidiary entities which is in no way under the control of the parent. So technically, if all the subsidiaries are wholly owned subsidiaries, means parent is holding 100% stake, this figure should be zero because entire equity of the subsidiary is under your control. I think that is sufficient to explain this bifurcation. But in this case, this bifurcation has no implication. It is just that the way it is appearing in the balance sheet which has been reproduced here. So for some strange reason, you are finding equity figure in both the years is same. We can't help it. It is just that way. Then the average equity figure is therefore 6458. I think this is done. So we have three average figures, NOA, NFO, and equity. Now that you have NFO figure and equity figure readily available, you can straight away proceed to calculate financial leverage NFO by equity, 0.95. Please don't think that if the financial leverage is based upon net debt figure, NFO is what? Net debt. If you're not comfortable with the acronyms used by Penman, you can comfortably call it as net debt. Earlier, you used to say that debt by equity is the financial leverage, but we have tried to bring a correction to that concept, isn't it? So we'll say it is net debt by equity, 0.95. Please understand that your numerator is net debt. Quite possible in a company, the financial assets are a good number. Then compared to the debt by equity, conventional debt by equity ratio, which is, for example, say 1.8 or 1.9, or for that matter, 2 even. Debt is 2 times that of equity. FLAF is based upon net debt because you're knocking out one portion of debt. That is obligation part I'm referring to, because you have some kind of financial asset. Therefore, FLAF, when you mentally compare FLAF of 0.95, please understand that it is a quite a good number. Means what? It is not that it's a very low, debt equity kind of ratio. If you look into, Penman's book has given you across industries for thousands of companies in US. They have just given you some kind of data, which is median debt equity ratio and median FLAF, that is NFOY CAC figure. And I think the median figure they have given for thousands of listed companies across industries is somewhere. I'm not able to recall exact number, maybe 0.75 or so. It's pretty low. And when you have a company with 0.95, it is sufficiently leveraged. That's the point I wanted to drive home. Okay. So that is the calculation which we did just now. That's over. Then coming to the next figure, average OL figure, we would not require at the outset. We'll come to that later on, because if you want to extend the profitability calculation, there is another equation which I have not been able to push through by this time in the classroom. I'll attempt to explain that in this video itself, so that maybe we can free some time in our class. Okay. So for the timing, please park this number just like that here, and we'll move ahead with our known numbers, known calculations we have already made in the class, isn't it? So let us calculate our ROC. But to calculate ROC, you know that we need the comprehensive income, and to calculate RNOA, we need operating income. Therefore, you cannot escape from reformulating the P&L. In this video, we are just going to learn few things about allocation of tax expense amongst multiple items we're trying to filter through the P&L. Okay. This reformulation has attempted to further bifurcate operating income into two distinct parts. You can see, I'll just highlight. I'm just sorry. 1 minute, please. So you can see that they have some operating income from sales, because operating income might have some items which are not necessarily coming from your sales figure, because sales figure operating income is more or less perceived to be a durable number. Not I'm not using the word durable in the sense this figure will be repeated in any case for you. That's not the idea. But any income coming from your sales is a regular source. There is nothing unusual about it. That's the point I'm trying to make here. So you are trying to split the operating income into two parts. 1 minute, please. If the phone would disturb again, I'm just trying to switch it off. Please bear with me. Yeah, done. So coming to the income, which is from sales part, you can see we have taken revenue, and then we have taken the costs associated with generation of this revenue. For example, cost of sales, administrative expenses, advertising, R&D, anything related to operations you have to take here. Then as usual, you have operating income from sales before tax figure. So question is, in the P&L, you don't have split of the tax expense. You have one line item called tax expense. Of course, the total tax expense would be a summation of two taxes. One is called current tax, the other would be called deferred tax. When I said that the tax expense is just one line item, I'm referring to the aggregate of these two lines. But the point I'm trying to make is that this kind of allocation will never be there in the face of the P&L, isn't it? You have to do it. You have to understand which portion of the comprehensive income will be related to what component of the overall tax expense. What I mean by this, I'll just demonstrate through numbers. In the P&L of General Mills, they have reported total tax expense of 622. Okay, that is of course summation of both deferred tax and current tax. Now, if you want to attribute this tax expense to only this item, that is operating income from sales, then you need to first figure out how much of tax is attributable to the remainder items in the P&L. So if that much you understand, then I think the tax allocation, the calculation will be very simple for you. So I think we'll start from the bottom, then it will make sense for you. For the timing, please omit this 8. This P&L has net financing expense position. It is not a case of net financing income or net financial income. Okay. You have interest expense of 449. It is there in the P&L of General Mills. Nothing extra you are trying to do. And they have interest income of 27. So you have net interest expense before tax. You can write this is of course NFE before tax, isn't it? Let's write it. That is before tax NFE is 422 and the previous year is 427. Done. Then the case has given us the tax rate, income tax rate, which General Mills is supposed to bear. Okay, that is 38.5%, and that is 162. I think in the classroom this figure was 170. I said that 8 million of difference I'll figure out. Okay, I have sorted out the file. Okay, so 162 is the tax on 422. So net of tax, it works out to 260. So the moment you attribute 162 of tax expense related to this item, question is, when you go for the adjustment of the reported tax figure 622, should you deduct it from 622 or should you add it? That requires a very simple understanding. You just think that General Mills P&L hadn't got this NFE figure. There was no financial expense. There was no financing, income. And obviously, the tax benefit on NFE would have been zero. If it is zero, then it should have been 622. But it is not zero. There is NFE, positive NFE, means that has helped the tax expense of the company to go down because of the tax held on the NFE figure. Therefore, if you want to relate the tax to the operating income part, the tax should have been higher. In absence of NFE, the tax should have been higher, isn't it? That's the reason why we are adding it here. 162 is an addition here, and you can see the overall impact of the numbers here. You are deducting 162. So in essence, you are not changing the 622 overall tax expense in the P&L. I hope you got it. Any part of this video based lecture you are unable to connect, you are absolutely free to ask this particular question or any question in the class. Okay, please do that. Please keep it in your mind and then ask me when I meet you physically in the class. Okay. Then I think that we have taken care of. So we have NFE after tax. So let me just highlight for the sake of our control, the portions we are discussing. This is over. Obviously, my overall operating income after tax minus this NFE after tax will give me my comprehensive income. Done. So now let us move back. So we are here. So 622 is the tax expense as reported. Now we have brought a component which is attributable to net financing expense 162. So the overall expense, tax expense for the timing would be 622 plus 162. Then what is this 8 all about? Let us move further in the P&L. General Mills has gone ahead with some kind of business restructuring. So business restructuring is not a conventional day-to-day operating expense. So this expense is a bit unusual, non-recurring in nature. But if you find a kind of company, let us say the company that comes to my mind would be, say, Cisco. Yeah, Cisco is a company which is famous for inorganic growth. Means what? It just doesn't expand its operations, experience higher sales and higher profit. It acquires companies, consistently it acquires business farms, and then brings in a lot of growth to the company through business acquisition. Some of the analysts in Wall Street, they think like this. A kind of company like Cisco, business acquisition is a kind of normal activity. There is nothing unusual for a company like Cisco. It is very, I'm say when you say mergers and acquisitions activity is normal activity for a corporate, that is something bit rare, isn't it? But yes, coming to General Mills, I don't think this is a kind of company where business restructuring is going to be a constant phenomenon. So anything not related to sales and the day-to-day expenses related to sales, you can find these expenses as day-to-day expenses related to sales. So we attributed this kind of expenses to revenue to calculate operating income from sales after tax. But this expense is not usual expense. Therefore, we are keeping it under other operating income. It is not an income, but we are interested to calculate overall other operating income. Overall other operating income for a company may be minus, may be plus, depending upon whether it is a question of expense or income, right? That should not bother you. The moment you bring this expense, restructuring charge and impairment charge, I don't think in your FRA course I pitched in with the discussion of impairment. Let me use this opportunity to give you the concept of asset impairment in a very brief manner, okay? It is just not that we are trying to rush through the figures of general means only. Anytime you come across a concept or a word even in this domain, it is always desirable you should have some clarity. So I'm just using this opportunity. Let us assume that I have an asset, one asset. I'm trying to give you the concept vis-a-vis one asset, but not necessarily this concept is a valid concept for standalone assets. Quite possible you will not be able to calculate the value of a single asset in a particular company because the asset is not generating cash flow in a standalone fashion. Asset in combination with several assets is capable of generating cash flow. Then in that case, for understanding the concept of impairment, you have to move to a concept called CGU, cash generating unit. How do they define this cash generating unit? It is a combination of assets and liabilities could be, yeah, it's a package, right? You perceive that to be either a business unit or even a part of business unit whose cash flow is independent of the remaining cash flow in the company. Then it qualifies to be called as a CGU. I think your strategy course and other courses might have given you a concept called SBU, Strategic Business Unit. Quite possible within a strategic business unit, there could be multiple CGUs also. I think this explanation will help you to visualize what could be a CGU in a company. So if it is a CGU, then you have to deal with the CGU as one independent unit within the company itself, which is capable of generating independent cash flow. That's the way you have to think, okay? But once I have explained the CGU concept, let us take at this stage, let us not complicate the concept. I'm just dealing with one asset. I'm assuming this single asset is capable of generating independent cash for my company. So the value of this asset in the balance sheet is, let us say, 100 crores. And you know that I would like to call it as book value, the value that appears in books of accounts. So GAAP is saying, after you have calculated depreciation on this asset, for example, depreciation for this asset in the year is 10 crores. Then the book value will reduce to 90 crores. So 10 crore is the normal depreciation, whatever method of depreciation we are following, and whatever is the rate of depreciation you have for that asset, please go ahead with depreciation calculation in usual manner. Then the written down value of the asset is 90. Today's IFRS or today's GAAP is saying you cannot just leave this asset value at 90. You have to test whether the asset value stands impaired or not on the balance sheet date. What does it mean? The word impair means what? In English, I think it will mean something like the value is endangered. There is some kind of, in some way the value has been compromised. So just to give you a very, very brief idea on impairment, let me give a simple example. Suppose we are selling Prajapati biscuit, our famous product, right? Azuba Private Limited is selling Prajapati biscuit in, let us say, some part of Tamil Nadu, because it's not that big a company. So think about the assets of Azuba Private Limited. Let us assume that in the market in which this company is operating, there are now some multinational players who are offering better tasty biscuits, and they are having better distribution channel, etc., etc. So their entry into my jurisdiction is suggesting to me, or possibly could suggest to me, that the cash flow I'll get from this business, that is Prajapati biscuit business, in the future, maybe it stands impaired with this new competition coming into the market. Therefore, it is possible the value of the assets I'm carrying in the balance sheet, that value I'm not going to recover. That's the philosophy behind the concept of impairment. So is it that the value of the assets I'm showing in the balance sheet to the world, those values are compromised, impaired, endangered? If that is the case, then how do you proceed with recognizing the impairment loss in asset value? They bring in a concept called recoverable value. So they say that this is the book value. Book value of this asset is 90, but you go ahead with recoverable value. What is recoverable value? It is higher of higher of two values. And what are those two values? It's not very complicated. You just need some kind of patience, okay, to connect. So higher of two values. What are those two values? One is, they'll talk about, let me just type it out, fair value of the asset less cost of disposal. Then the other value is, I'll explain. Just let me, the other value is known as value in use. So two values they are trying to bring in, and they are trying to say, you take higher of these two values, as recoverable value, okay? So question is, if you have an asset, think like a business person. If you have a business asset, what are the two ways you'd like to get value from that asset? One way out. Today I will sell the asset, and net of selling cost, there could be some cost of disposal of the asset. Example, as per the contract with my uh, buyer, I am supposed to dismantle the machine and then load it. That much of cost is on me as per my contract with the buyer. In that case, let us assume that costs me 50,000 rupees, dismantling and loading cost, okay? So obviously I can say that that's the cost of disposal. So what is fair value of the asset? As you know, I had given you the definition of fair value in the class. It's an exit price of the asset. I'm trying to dispose the asset, right? So that's the fair value. Suppose by selling this asset, fair value less cost of disposal I will get is, say, just a number, 85 crores. I'm assuming this 90 to be in crores. Done. Then the other option for me to realize value from the asset is what? Not to dispose it today, but I'll continue to hold the asset and commercially exploit it. If I do that, then the asset will generate future cash flow for me. And I think you are kids in the second year, so you know at least DCF model. So the net cash the asset is generating for you. Net means what? Net of expenses, right? The asset is generating for you. You take an appropriate discount rate and then discount it to calculate VIU. That is called value in use. I think these are two generic ways I can look forward to recovering the value of an asset, whatever asset I'm carrying in my business. Either I'll sell it today and net of selling cost, how much I'm going to get, that I must calculate. And the other one is, if I don't sell it, I continue to use it, exploit it in my business, how much value it is going to generate for me. Suppose that is, let us say, 87 crores. 87 crores. Don't you think this calculation, I'm just sorry, this calculation itself is going to suggest whether you should go for divestment or you should go for continued use of the asset. Suppose this number is, let us say, this number is, say, 90 crores, and this number is 87 crore. What are you going to do in business? Of course, sell it today. Of course, sell it today. I think you have every right to ask the question, how is that? I conclude that today's value in use is, say, 87 crore. But if I'm going to sell it in the market, net of selling cost, I'm going to get 90 crores. Don't you think there is a high possibility the value you are going to get from an asset could be fundamentally different from the value another person is going to generate that asset? Because you never know what are the other business units that person is having, what are the other assets that person is having, and when this asset will be used in conjunction with those assets, the kind of synergy or the economy you will experience in that business environment may be very fundamentally different from my economy, isn't it? Or my synergy, isn't it? So in that case, the value would be different. So there is every possibility. Somebody who is trying to buy the asset from you is willing to pay you more. That should not be a surprising point, isn't it? I think that clarifies the conceptual problem associated with this departure. How is that it will be 90 or this would be 87? Is it that the other person or the buyer doesn't know this value? Yes. So once you are comfortable with these two concepts, then gap is saying take the higher of these two values. So I should take 87 crore instead of 85 crore. I'm taking 87 because value in use is higher. So you can see that here recoverable value is clearly below the book value. Means gap is saying if the maximum value you are going to recover from the asset is 87 crore, then why are you going to show the asset at 90 crore to the world? It means there is an embedded loss of 3 crore in the value which you are showing in the balance sheet. And this value you are never going to realize, neither through sale of the asset today, nor through continued use. Therefore, write down the asset value to 87 crore. Therefore, you say if recoverable value as a number is less than book value, then it is a case of charging impairment loss to the P&L. So in this case, 3 crore impairment loss will charge to the P&L, and through that loss recognition will bring down the asset value to 87 crore in the balance sheet. One thing about impairment loss you need to understand, impairment loss is in addition to current year's depreciation charge. That's very clearly written in the gap. Therefore, first you calculate depreciation and then the written down value, that is 90 crores, should be tested for impairment loss, not that 100 crores should be tested for impairment loss. Okay, then a little more about impairment as a phenomenon. The reason for impairment could be an internal reason. Example, just an example. Hey, this itself is a huge gap. Okay, we're just trying to summarize within 10 minutes time. I'm just using this opportunity to explain that concept to you. The reason for impairment could be very much within the boundaries of the company. Example, for some strategic reason, the board of directors of a company take a decision not to exploit a particular business unit to some extent. Okay, it is not necessary. It is not necessary that in business, only loss-making units are sold. Quite possible for some strategic reason the company could try to exit or scale down the operations of a profitable wing. It defies our common sense, but sometimes it could happen. I believe quite a few years ago, I think now it is 3 to 4 years old story. Philips, it's a global company. Philips shocked the investing community by declaring that we might, that point of time, this press release came. Philips board of directors are thinking to slowly phase out lighting business. Can you visualize the existence of Philips without this business? The main core business for which they're famous, and they are making pretty good profit from this line of business. It's not that the profit opportunity for the lighting business has died down, but at that point of time, the analysts made this is analysts rumor, okay? They try to say that Philips tries to or is trying to concentrate on more profitable products, that is beauty products, hair dryers, and a lot of, I think, the lot of beauty products they have for people. Okay, there the margin is much more than the margin they enjoy in the lighting business. But anyway, it did not happen. I don't know. I was not following Philips. So what happened later on, whether they reversed that decision or the decision has been suspended, I'm not aware about that. You may check by Google what ultimately happened, or maybe the directors reversed that decision because shareholders might have exerted some kind of pressure. This business is giving us still good margin, and why do you want to exit from the business at this point of time? We'll revisit the decision maybe after 5 years or so. That is possible in business, isn't it? So that is the concept about impairment loss or charge. So here the charge is 3 crores. Given this explanation, I think you are in a better position to connect this line item, restructuring and impairment charge. It is not necessary that for every company impairment charge would happen as a regular item. It's a bit irregular item. Okay, done. So since it is an expense like an fee, you'll have a tax shield on it, isn't it? So you apply the same tax rate. Tax shield on this expense is 8 million. Since you are separating this item from operating income from sales, that figure, so you are readjusting this as addition here. Means if this expense wouldn't have been there in the P&L, obviously, had the company got only these items, let us say revenue, and these expenses, only these, let us say how many lines? 4 lines. Okay. Obviously, the tax expense of the company would have been higher. So that's the concept involved here. So you reduced 8 here, and that's why you are adjusting 8 here. Therefore, finally, you are saying my tax expense attributable to income from sales is 792. I hope you got this figure. And in case somebody is not getting it, please ask me in the class. Okay. Then 2249 minus 792 gives you operating income from sales. Though in this case, we are not going to use these figures separately from the remainder part of operating income. But obviously, if you're trying to dissect figures again and again till a stage where the figure cannot be further probed, then I think this decomposition will help you. I think that part of the story I will explain. It's just that you go on decomposing the numbers because individual variables impact on overall profit you are going to assess. So in that larger map, this decomposition will be helpful. So coming to some of the items in the P&L, some of the items could be under OCI, some of the items could be in the P&L, but they are not related to earning of income from sales. So we are just putting that as other operating income. Like you have earnings from joint ventures, earnings from associates, that's a straight away profit share. So I have already explained in the class, if you recall, this earnings share from JVs and associates is after tax item. So to to an after tax item, you're not going to allocate any tax expense, right? Common sense. You will not count tax twice. So that's why the heading here, you can see that other operating income after tax. But here it is other operating income before tax. Since it is an expense line item, in the outer column, you have straight away taken it as minus figure. So it will be easy for you to add it, okay? Currency translation gain or loss, okay, is translation gain, as you have told in the class, the last class, if you recall, is related to foreign overseas subsidiaries, right? Their currency is different from your reporting currency. So when you prepare consolidated statements, you translate assets and liabilities into the reporting currency. And the gain or loss comes to OCI. It doesn't go to the P&L, which affects net profit. Transaction gains and losses go to the P&L, right? So anything that comes to OCI is after-tax item. In Indian companies, you'll find OCI items are also given as before tax items. Below that, immediately you'll find the tax component. Always remember that the tax component attributed to the OCI item is always a deferred tax. There is nothing called current tax out there in OCI section. This point you should always keep in mind. I'll repeat. In the main body of the P&L, when you are calculating net profit, you have two components, current tax and for tax. In OCI section, you don't have a concept of current tax. It's all about deferred tax. Okay, keep this point in mind. So then these are all after tax. And hedging gain and loss, you already know. Obviously, if you're referring to OCI, hedging gains and loss, that will be cash flow hedges, and that too effective portion. Ineffective portion will in any case go to the P&L and affect your net profit figure. If it's a fair value hedge, I have not been able to push through fair value hedge accounting because, you know, we're struggling with time. The file that has gone to you, one of the sheets in that Excel file is fair value hedge. Please remember to connect to this discussion, fair value hedge gain or loss will always hit P&L. It will not come to OCI, right? It's a cash flow hedge, effective portion will park temporarily under OCI. So these are all OCI related items. So it's all after tax component. So if you just sum it up, then you are having other operating income after tax 465. That's the summation of all these. Starting from here, restructuring and impairment charge, that's an expense, so negative figure. And here you have some hedging loss, that is -2. The figure is 465. Okay, done. So if that is the case, then your total operating income is 1909. Now 1909 you have split into two parts, 465 and then I think 1457. That is operating income purely from sales. This is the format you have to apply for the second phase of your project work. You can always refine the reformulation as I had told you already, okay? And you are doing it in an incremental fashion that you manage time, okay? Because all of a sudden I ask you to deposit the total project, it will create undue pressure on you. So you have all the time to improve that, modify your work already submitted. And I think through this discussion, you also understood how do you allocate the total tax expense as reported in the P&L amongst multiple heads, right? You stick to this pattern because I don't think you will connect to some discussion which might tell you that Indian tax law is a little bit different from American tax law. Of course, it is different. Therefore, you just don't apply the statutory tax rate to the remainder part, because effective tax rate could be a better choice for the timing. Avoid that confusion. Okay, because yes, in terms of sheer technicality, the subject would always require refinement plus refinement in understanding. And I think you kids are already aware that it's not feasible for me to explain the nth stage of that discussion in one go. We are just trying to build arguments in an incremental fashion. I hope you just get that point. Okay. Yeah. So then I think all the figures are ready. In this case, we'll just use this aggregate operating income 1909. So we're back to the calculation. So we have all the figures with us, and then we calculate RNOA. I'll just use this cell. RNOA should be operating income divided by average NOA. So this figure would be, I think, 1909. That is total operating income after tax divided by, I have this figure, average, is it average NOA? Yes, 12572. And then I would like to express it as a percentage. So I'm just multiplying with 100, isn't it? See, 15.18%. I think I'll not demonstrate the calculation of every figure. You please follow the figures in the file. You can know it. So RNOA has been calculated. Then ROC would be what? Comprehensive income. This 1649 divided by average equity, that is 6458. You can just click it and know that figure, isn't it? Yeah, I33 by C31. Okay. So that is 25.53. You can see here itself that your RNOA is levered up to the extent of 25.53. Roughly the spread is here how much? 10%, 10 point, maybe 35. Yes, to be precise, 10.35% is the extra return over and above RNOA you are generating. For the simple reason, this company is using debt positive financial leverage that is reflected in this number 0.95. Okay. And you require the other component NBC. If you connect to the overall equation, what is the overall equation we talked about in the class? This is the equation, right? Yeah, ROC should be in capital, isn't it? ROC is equal to RNOA plus FLAV into RNOA minus NBC. And you know that this spread RNOA and NBC, we try to call it as operating spread. Operating spread. So then this NBC figure is nothing but the rate at which NF is incurred upon NFO. It's a rate only, percentage, right? So you have NFE figure after tax 260. So 260 by your average NFO figure, which is already available with you. I think average NFO is 6114. Yes. So that NFE divided by NFO is giving you 4.25%. Therefore, if you recall, we always said that every component is after tax component. Now you can see, if I just use this cell is equal to, I want to establish that equation, whether that equation is truth or not. So is equal to RNOA, that is 15.18, plus I have my FLAV. FLAV is 0.95. And then I have this difference of that is 4.25% and 15.18. Okay, let me just hold this figure. I think I have, yeah, it is here. I just missed it, sorry. Its figure is here. The spread is here already, 10.93. So my overall figure ROC should be equal to 15.18 plus the FLF 0.95 into this figure 10.93. That's the spread, operating spread, difference between RNOA and NBC. So that is 25.53. So how does it help you? How does this decomposition help you? Why should you do so much? of, back office work to migrate data into Excel, then reformat the financial statement, then find out these individual components. Let me tell you, up to this stage, even this work is at a macro level. You have to further dig it down to individual figures, okay? But at this stage, we are trying to say impact of FLAV is 10.35%. So the base return from business is 15.818%. Don't you think if you have similar figures, which you are going to do in your project, you're comparing three companies, I believe. So maybe just for the sake of concept, let us assume the ROC figure is more or less similar for three players you have chosen. May not be the case, but let us assume that. Is it not possible that one player out of those three players has a significant component of ROC springing from the way it has been financed? That's a risky ROC, right? So obviously, I would love to see a company's ROC fundamentally springing from here. RNO itself is a large number. There is a second aspect of a large RNO number. Adversities of business in the market can pull down your RNOA. But the fact that it is already a very high number means what? You are not that risky a company. But how about a company whose RNO is just say 5% or 6%? A little shift here and there in the market, maybe because of competition, or maybe because of, let us say, hazards like say COVID, for example, okay, can pull you down, isn't it? So at this stage, I think this case just wanted to take you through that equation through a life case. Okay, so this balance sheet is positively leveraged. Now that this calculation we have done for General Mills, it is just that in case of Nike, Hugo, maybe the balance sheet will have negative financial leverage. So then this equation will look like the second equation we discussed in the class, if you recall, right? So does that? Otherwise, fundamentally, the reformulation calculations will remain same. I think assimilation of the ideas. Okay. So let us see the balance sheet of Nike. Here you have 3 years balance sheet. Yes. Coming to this working cash, the case has told us that take 0.5% of sales as that's your revenue as working cash. This is a kind of convention some of the analysts use in Wall Street. Okay, I think the book has pulled that kind of practice into the discussion. But I think on the subject like Damodaran vehemently, I think dislikes this kind of approach. Okay, I think we discussed this point in the class itself. What is working cash? In that context, if you recall, I explained to you the concept of wasting asset. And therefore, in today's context, it is very difficult to perceive some cash as working cash. Given that, we're just going through the number. I don't think anything you require to be explained. You have total operating assets. These are all conventional items, isn't it? So then, as usual, you have operating liabilities, accounts payable, and you have DTL also, deferred income tax liability, and accrued expenses means expenses payable, etc. It's a very simple items, nothing to explain further. Then as usual, you have NOA, then you have financial assets. Here, the balance sheet is dominated with financial assets. Financial liability is less than that. Therefore, you have a NFA situation. In that way, I think the book is a very nice book. Okay, unfortunately, we don't have the current edition. What to do? I wish I had a similar book available in the market. So you have NFA situation. So if you have NFA situation, of course, total equity would be equal to NOA plus NFA. That is just to establish arithmetical accuracy of your reclassified balance sheet. Nothing you have omitted. Once you get the assurance, then you go ahead as usual, NOA, average NOA, average equity, average NFA. So since it is NFA figure, and we say that it's a case of negative financial leverage. Okay. Here in this cell, I have put this number as negative number to imply that it's a negative leverage case. Okay. But when you write the equation as minus, again, don't take this minus figure there because minus of minus would become plus. I hope you see this simple point. Okay. So let us go to the P&L. You can see the same pattern as usual. Nothing further to explain. But only one thing I would like to explain. When it comes to tax adjustment, can you see you have net finance income in the P&L. Therefore, you will have some tax expense attributable to that. It is not NFE. Therefore, it's not a case of tax savings or tax sale. Had it been tax sale like General Mills, we are adding it. But here we are deducting it because this is also positive income present in the P&L. So tax expense as reported is 619.5. And out of that, 28.1 is attributable to NFI. So you deduct it. And similarly, you have some other operating income. So on that, you have 22.1 tax expense. So you are deducting it. Then the same pattern. Yeah, the tax rate is different. You know, in US, it can vary from company to company. More or less same kind of items, currency translation gain, hedging gain. Yeah, this is something unusual. The effect of accounting change as per US GAAP, Nike was forced to recast some figures because of change. Okay. But this will not be a regular item, so forget it. And this change they have reported under OCI, net of tax. Okay. So you have, again, in this case, we are concerned with total operating income. That is 1882.7. And you have net financing income. We called it as net financial income. That is absolutely correct, not wrong. Okay. So 49 is the net financial income after tax. Okay. Once you have net financial income of 49 and you have NFA, I think easily you can calculate RNFA, that is return on net financial assets. You can see that figure. Is it calculated here? I have calculated. Okay. RNFA is equal to 2.35%. These are all percentages. Okay. Done. Then RNOA, I don't think I'll explain these numbers. How do you calculate? It's boring, isn't it? So you have the three numbers, ROC, RNOA, and RNFA. You just need to observe that this RNOA 35.63% translated to final return for the shareholders, which is much less. So roughly you have knocked out maybe 9.4% out of RNOA when it comes to the rate of return for equity shareholders. Because of what? Because of these useless assets. I call it as useless asset from shareholders' perspective, right? That's why you'll find that shareholders sometimes will not be happy if the company is carrying too much of financial asset in the balance sheet. Okay. So this negative financial leverage is accounting for this decline of RNOA to 26.21. Okay. So and if you go for the component wise calculation, you can re-establish that the truthfulness of that equation. Okay. So once you are comfortable with this calculation, then one interesting question we can ask. You know that Nike's balance sheet has NFA, means what? There are some assets in the balance sheet which are of course not generating 35.63% return. Your business assets are giving you, or your business is giving you that return. Maybe in US kind of scenario, the financial assets will give you 2%, 3% kind of return, or max to max say 3.5% return, isn't it? So question is, why do you carry these assets? For what reason? You think about a company which has parked these assets for some sufficient number of years. What does it mean? It means you are not going to use it for your business. Definitely, it looks like the market is not giving you that growth opportunity to add to your capacity by bringing in further operating assets into the balance sheet. Then why park it? Why destroy value for the shareholders? That's the question. Given that question, we're just hypothetically asking, what if, what if Nike would have paid out $1 billion as dividend to the shareholders? So obviously, it's a big money. If you want to pay out this dividend, you liquidate your financial assets and generate cash and pay dividend. In that case, just look at this number. Before this hypothetical dividend payment, your average NFA is 2086. And once you clear this dividend payment, it will of course drop to 1086, isn't it? Cash will move out. You will sell some financial assets and get cash. Ultimately, cash will move out from the balance sheet. Then, of course, at the same time, the equity will also drop because dividend is what? Reduction of equity. So two figures are getting corrected. Equity of 7370 will drop to 6370, and average NFA will drop to from 2086 to 1086. Then question is, this FLF, this number will also change, isn't it? That is B42 by B43. So we are taking the revised number. Still it is NFA. Please don't get this. You should not understand that this is a positive financial leverage. I have not put it within bracket, okay? That is the absolute value I'm referring to. But since you have still NFA, it's a case of negative leverage. But you will find with this dividend payment, since this number is reducing from 0.283 to 0.170, the decline, that part I'm leaving consciously to you, okay? You please find it out, okay? You'll find that 35.63% is not reducing to 26.21. It will reduce, but the decrease is not that pronounced. That is like 9.4 percent or so. It will not decline to this level. Maybe number would be 29, 30. You just work it out with this number 0.170. So I think once you work out that, then you will appreciate that yes, paying dividend is making sense. That is when the market started punishing Microsoft case on 5th of September, the class will go through. We'll get into that Microsoft case. I have mentioned that case a couple of times in the classroom, isn't it? There you'll find a heavy financial asset was present, and because of several reasons, that's just not one reason why market was punishing share price of Microsoft. Now, I think with this much, we have come to a conclusion as far as General Mills and Nike, both cases are concerned. In one case, you have positive financial leverage. In another case, you have negative financial leverage. Okay. Now, the next issue is that what to do from here, what to do. Let me use this time window to push through that incomplete discussion. Now we'll turn our attention to another leverage. That is not financial leverage. Question is, presence of operating liability in the balance sheet. Is it in any way impacting our profitability? That's what we want to discuss right now. So I'm just using this as your whiteboard. So you need to be with the argument, then the equation would look easy. I think equation is disturbing some of the kids in the classroom. That should not be the approach. You don't get an equation when we discuss it first time, but you stay connected, you'll get it. It's not rocket science. So let us assume that my company is heavily using trade payable because for my positioning in the market supply side of my business, I'm enjoying a lot of liberal credit terms from my suppliers. So the operating liability here I'm talking about is only in the context of trade payable because it is easy for you to understand what we are trying to talk about in this whole uh, you know discussion. Okay. So let us assume that I'm using 500 crores of trade payable. Okay. For HUL, Hindustan Unilever, this figure could be close to 7,000, 8,000 crore. Check it in the balance sheet of HUL. Okay. So 500 crore is the operating liability. That is trade payable. Don't you think when the supplier supplied material to me on credit, obviously the supplier would have built in some additional cost into the price. But unfortunately, that added cost, which is the real interest cost, she is trying to build into the price of my material I'm procuring from her, right? It's not visible in my P&L as interest cost because it is embedded within my material cost. So because of use of trade credit, that is trade payable as a source of finance, I can now clearly understand that my cost of goods sold figure has gone up a notch because of the inflated cost the supplier is charging as opposed to cash payment based price. This is a normal thing, isn't it? So now that I know, because of use of this operating liability, my operating income is down. Operating income is down. Then I am curious to understand, had I not used this credit, then how my operating income would have looked like. I'm repeating, had I not used this operating liability in business, means if this trade credit were not available for me, how my operating income would have looked like. So I need to bring in an implicit cost of using the trade credit. Why do I call it as implicit cost? Because the added cost which the supplier is charging me is not explicitly visible. So to catch that hidden cost, that implicit cost built into my material price, I have to bring in a proxy, market proxy. So what is the proxy? The argument should be very simple like this. Had I not got the credit from the supplier, what else I would have done in my business? Obviously, I would have knocked the door of a bank or financial institution to take short-term credit for purchasing material, right? Then in that case, I would have something called short-term borrowing rate on the loan I will get. So SBR, since everything we're discussing must be after tax, SBR should also, it's a rate. For example, short-term borrowing rate for me is 7% done. And let us assume the tax rate is 30%. So SBR after tax would work out to 7% minus 30% of 7%. That's 2.1%. Therefore, my SBR after tax should be 4.9%. Okay, done. So once I get this, if you check American financial statements, you'll find that they reveal these numbers. Please understand one thing, the quality of disclosure and the figures, the quantum of disclosure in US GAAP and also voluntarily many companies reveal many figures that is far superior compared to our Indian companies. Okay, I think India is yet to catch up with that kind of voluntary disclosure. Corporates must reveal numbers to facilitate computation in the capital market because analysts follow these numbers. They use these numbers, isn't it? So they supply the SBR short-term borrowing rate separately and long-term borrowing rate separately. So if it is not given, you please pull some market proxy, then work out the SBR. So after tax, the rate is, say, in this case, 4.9%, isn't it? If that's the case, then obviously if I'm using on an average operating liability of 500 crores, the implicit cost of using this 500 crores, I'm just writing it here, implicit cost will be equal to operating liability into the SBR, that is the short-term borrowing rate after tax. Okay, so in this case, therefore, it would be equal to 500 crores, into 0.049. That is 24.5 crores. So I know now, had I not taken this operating liability, had I gone for a short-term explicit borrowing from a lender, then my operating income would have been higher by 24.5 crores. Therefore, the corrected operating income means hypothetically, I'm assuming I'm not using operating liability in my balance sheet, would be equal to operating income plus the implicit cost, right? Therefore, this is the modified operating income if your balance sheet doesn't have operating liability. If you connect to this much of discussion, I don't think the equation would intimidate you. We go very slowly. So I know that my RNOA figure is equal to operating income by NOA, right? So I want to study how the RNOA figure is actually getting generated, because RNOA figure, it looks like in the denominator, I have already deducted operating liability, right? Operating asset minus operating liability is in the denominator. And I am curious to understand, had I not used operating liability, how my profitability would have looked like. I don't think this is such a difficult thing. You will not be able to connect, isn't it, my dear? So what we'll do right now, we'll try to study if my operating liability would have been zero, then I'm just concerned with operating asset. There is nothing called NOA. NOA is equal to OA because OL, operating liability, zero. So this is my gross investment in operations. NOA is a net investment, right? This is my gross investment in operations. Done. So the return I would have got on OA is this component, right? This is not OI, but it is OI plus IC, because I'm not using operating liability. Therefore, my operating income should have looked better because I could have managed to buy the material at a cheaper price. That's the argument we're persisting with to get the concept, okay? Therefore, my return on operating assets, RUA, you may laugh with this kind of pronunciation, okay? So if I pronounce it as RUA and you kids pronounce it as RUA, you'll never forget it, right? So for God's sake, don't pronounce RNO as RONA, okay? So RUA is equal to, obviously I will have the numerator operating income plus implicit cost of using operating liability divided by OA. So this would have been my profitability as far as my operations is concerned. But I have a number RNOA. So we'll just go ahead. So if it is RNOA as compared to RUA, how RNOA figure is a leveraged figure, we are trying to figure it out through mathematics only. So RNOA is equal to OI by NOA. So what we'll do, we'll try to bring in that implicit cost into the equation and see where we go. We're just playing in terms of a variable. We are inviting that variable into our equation, right? So we have operating income plus IC. So once you invite a variable into an equation, you have to drop it, minus IC. Then as usual, we have NOA in the denominator. Then we'll try to decompose the numerator into two distinct parts. That is, OI plus IC will try to keep it as one component divided by NOA. And then we'll have minus implicit cost of using operating liability. I'm knowingly repeating it because repetition possibly reinforces, right? Implicit cost by NOA. And then we'll use this place to proceed. So just ask a simple question. Operating income plus implicit cost. I think this numerator is having better nexus with OA, not NOA, because IC is the implicit cost of OL, means you are not using OL. Therefore, why the denominator should be NOA? It should be OA, right? So we just proceed. Then I think you are trying to repeat that, isn't it? So just repeat this component in the numerator and you just bring in OA into the denominator. You invite that variable. Then you have to drop it by taking it to the numerator, OA by NOA. And then same way you please ask, IC is not connected with NOA. IC is connected with OL, right? So OL you should invite to the equation IC divided by OL. Then as usual, we'll drop out OL from the equation by taking it to the numerator, OL divided by NOA. Okay. So this OI plus IC by OA, I think already we have got the concept of RUA, that is return on operating asset. So we'll just try to bring in that concept here, RUA into, we need this OA figure. You said that NOA is equal to OA minus OL. Therefore, here you have OA divided by NOA. Therefore, don't you think OA should be equal to NOA plus OL, isn't it? It's just derivation. OA is equal to NOA plus OL. So please bring these two variables in the place of OA. Here, this component OA by NOA, okay? So I go like this, is equal to, OA is equal to NOA plus OL, okay? Divided by, as usual, I have NOA. Then don't you think you had got that implicit cost IC by multiplying SBR with OL? So if this component is implicit cost by OL, it is SBR, right? Therefore, I'm just putting SBR. This component I'm talking about now, IC by OL, is equal to SBR. Why? Because you multiplied SBR with OL to get IC, isn't it? So it's the rate. SBR should be a rate, therefore. SBR into OL divided by NOA. Of course, it should be, there should be a multiplication sign here, okay? Done. So now you look into this. NOA by NOA will be 1 and you will have one component OL by NOA. So here we are just opening up the bracket. RUA into NOA by NOA. That is RUA. Okay. That is return on operating assets. Then I have one component that is RUA into OL divided by NOA. Then as usual, I'll return that second component SBR into OL by NOA. I remember finding OL by NOA as a common factor here. So we'll have the final version then, RUA. So I'm just taking that common factor, okay? OL by NOA. Then this whole into, you have RUA minus SBR. More or less, it looks like the previous equation when you had positive financial leverage, right? So this component OL by NOA is known as operating liability leverage, OLF. Please be careful not to drop the word liability from this expression, because the moment you drop accidentally the word liability, you are referring to operating leverage. You are no more referring to OLF. So operating leverage, I think your managerial accounting course taught you how the presence of fixed cost within the total cost is a cost structure related concept, isn't it? How that leverages your profit, isn't it? So in effect, now I can say three leverages are working. One is operating leverage. The second one, it looks like from this discussion, let us just complete the writing of the equation and then turn to this discussion. My final version would be, I'll just keep it at a safe distance, not to confuse you. Let it be here. My final version of the equation would look like RUA plus OLF, operating liability leverage, and the spread is RUA minus SBR. This is also a spread. The name of this spread is operating liability spread. This RUA minus SBR operating liability spread, okay? So this equation is finally trying to show you how presence of operating liability is able to lubricate or let us say leverage your profit. So the departure between RNOA and RUA is because of what? Which leverage? This the leverage, operating liability leverage. Okay, so quite possible the story could look like this. If General Mills final return, I hope I remember that number. Let me just check how much was the ROC. ROC is 25.53. So RNO is 10 point, no. RNO is 15.18%. Okay, 15.18% finally got enhanced to 25.53. So this 10.35% is because of financial leverage impact. Now you want to deep dive into this number, 15.18. How much out of 15.18 General Mills has been able to get because of use of operating liability? Done. So if that is your objective, you can see here how the final decomposition is looking like. So your RUA is 11.2%. And then this 11.2% is levered up to 15 point, I think 15.1%. This is rounding off you are doing here up to 1 decimal point. Okay. So the spread here 15.1 and 11.2% difference is because of what? Effect of operating liabilities. So this is all left impacting. I think it is roughly 3.9%. Yeah, it is here 3.9%. So 3.9% is coming from use of operating liability. Then financial liability use is generating further 10.4%. Therefore, imagine a hypothetical balance sheet for General Mills. You don't have any financial liability, you do not have any financial asset, you do not have any operating liability also. You recall those simple balance sheets I had created in the classroom for your easy understanding. So ultimately your ROC in that case, which balance sheet I'm referring to? You have only operating assets in the asset side and you have 100% equity finance in the other side. So your ROC would also be 11.2%. Then you invite some operating liability. Then it increases to 15.1% because you have 3.9% extra return for the shareholders. Then you invite some financial liability. Again, there is another component coming into picture, 10.4%, isn't it? Now from here onward, okay, what is the story? I think this video is turning out to be a very long video, but yes, students, we have come to a very, I think, a solid point in our overall journey. Okay, from here onward, we'll just maybe half an hour more will help you to uh, do further analysis. Means what? Now it is expense analysis and the shift from year to year to understand which expense is changing how much, therefore my ROI is changing by how much, etc., etc. So we'll just invite the DuPont framework of thinking into more micro level details. We'll do that in the classroom. Okay, I think you'll be able to follow this file. In case on any point of my discussion you are not able to connect, please ask me in the class. Otherwise, I'll assume that you all have, understood it. I request all of you to go through this video, and then we'll meet on third with Starbucks case. Please, if some of you want to read the text, it is already available with you. Please go through chapter number 9, and then we'll connect in the classroom. Thank you very much.